Like Charlie Munger once said, for a man with a hammer, everything looks like a nail. Is this the only parameter which an investor should be looking at, or what are the other aspects that one should really look at and make a more informed decision? What would be your advice? Welcome to another episode of Mind Over Markets. And as usual, with me today is Rahul Singh, CIO Equities of Tata Mutual Fund. Hi, Rahul. How are you doing?
Hi, Anand. I'm doing well. Good to be doing this back again.
Yeah. Month of March is usually stressful, and guess what we're going to discuss today? The stress test. So why don't you talk us through about what the stress test is all about and what are the things that we ought to be knowing?
Yeah, so actually stress test as prescribed by the regulator is to show and disclose the number of days to liquidate, say 25% of the portfolio. Also a lot of other parameters, because I think the focus has been on the number of days to liquidate, but also parameters like valuation, beta, also small caps valuation relative to large caps. So I think it's a good transparent exercise which all AMCs have done and disclosed on their website. So it's easier for investors to compare two things. One, small caps versus large caps as a category, and within small caps, the different funds and how they are being managed. I think the genesis of this was because the regulator also wanted to send out a message that while there has been a lot of inflows into small and mid cap, what are the things which the investors should keep in mind in terms of the risks? And I think to that extent, the stress test or the parameters of the stress test which have been disclosed are an effort towards sending out that message and information to the investors. This is not to say that this is to discourage or this is to create any kind of major concern. But I think it's a healthy exercise which everyone has done, and I think investors have taken note of.
But can you dive a little deeper into what is being tested here? What is the stress that we are testing here?
So what happens is, in a small cap fund, unlike a large cap fund, if I have to take two extremes, small caps typically have lower liquidity because these are companies which, at least for us, starts from a market capitalization of 2,000 crores going up to upwards of 20,000 crores. So that's the sample set you're looking at, and this typically has 650 to 700 companies roughly. And when you invest in these companies, because their free float is less, because they traditionally tend to be more promoter owned and therefore lower free float, their market capitalization is low. So the liquidity in these stocks is lower.
And free float, if you can just...
The free float is basically what is the percentage of the stock or the company's equity capital which is owned by non-promoter group. Typically in a large cap, you will see this number being 20, 30, 40, 50%.
Basically available for trading with
available for trading because you would assume that the promoter holding is not there for daily trading activity. So it's the amount of stock which is there in the market held by various investors. That's really the free float, and that is lower, the market capitalization lower. So liquidity can become a constraint in small cap, mid cap. When the times are good, you will see liquidity being good. But if and when the economy goes through a little bit of a downturn, the liquidity in small and mid cap can dry up. And therefore, if that is timed simultaneously with a heavy redemption pressure, which we'll talk about later, then it can create some kind of a stress on the fund to be able to liquidate, say 10, 15, 20, 25% of the portfolio in a short span of time. I think that is what is the stress testing all about.
Okay, so what were the big takeaways that came out of this stress test exercise?
Well, two big takeaways in my view. One is that while obviously the number of days to liquidate, say 25% of the portfolio would be more than large caps, and while the different funds will have different number of days to liquidate, But it's obvious that in a small cap portfolio, the liquidity numbers or the number of days would be on the higher side. So that is, quite obvious. But I think the bigger message there is that it is not very high. It is not, it's in the range of, at least for us, it's in the range of 15 to 20 days for 25% of the portfolio, which I would say for small cap is a very healthy number. So that's number one. Number two is that why I think that there are different funds having different approaches to managing small cap, and we can delve deeper into it if you want. But that's the bigger takeaway, that you also have to look at each fund separately in totality with other parameters of that fund, rather than just focusing on the liquidity ratio. And the third takeaway, if I may add, is that the liability concentration is not very high, which means the investor concentration is very low. In fact, more than me that the profile of the investors is very, very granular, very SIP based. So the chances that there would be an event where a large number of investors would come on the same day to redeem is also on the lower side. So we have to also look at that and draw some comfort from that.
Understood. And Rahul, does this vary from fund to fund? As in, how will this look for a very small fund? Is it any easier for a smaller fund and any more difficult for a larger fund? How do you see that? Does that play a role at all?
It does. I think if you look at a very small fund, let's say, I would say 1,000 to 2,000 and below would be a small fund today. In today's context, that is a small fund for small cap. Those will have better liquidity ratios, just by the sheer fact that you are holding lesser of each stock. So the number of days to sell would obviously be lower for you to sell, say, 25% of your portfolio. It's but natural. But once you cross a certain threshold, say 5,000-6,000 crores and beyond, then it's a function of how you manage the fund. Then it is not necessarily, you don't get any major advantage or disadvantage in terms of size. If you're very big size, then obviously it will become a disadvantage, but there are ways to offset it. But I would say it's an advantage, or the ratios will look better if you are a very small fund. But once you cross mid-size and beyond, then it's more a function of how you have constructed the portfolio, and also internally whether you have been conscious of these risks or not. I think that also is, plays a role. Even before the regulator came out with this stress test, we all have, policies, we all have risk control measures, and we manage liquidity. We are aware of all these issues, and we have been taking care of these issues in our portfolio construction in different ways.
See, I think ever since the stress test results are out, there's been a lot of chatter around, the numbers which are out after the stress test. And there's a tendency to react or act basis, some of the numbers. And like Charlie Munger once said, for a man with a hammer, everything looks like a nail. Is this the only parameter which an investor should be looking at, or what are the other aspects that one should really look at and make a more informed decision about how the fund is, how robust or otherwise the fund is? What would be your advice?
No, that's a very important point you have raised. In fact, I said that the number of days in itself don't look very high, so there is no need for it to be a big concern. But having said that, I also said that you have to look at these number of days to liquidate a certain percentage of your portfolio in totality with other parameters. And what are those other parameters? And I would like to give our example, because I would want to talk about how we have handled this risk which is there in the portfolio, is by taking care of the other parameters. So what you do is you offset the risk of liquidity with the way you manage the portfolio. Though that can act as a big offset. Apart from the offset, which I told you that For us, for example, top 10 investors are less than 3% of the portfolio. So obviously concentration risk is not there. So there's one single redemption creating a disruption in the portfolio is extremely
The
extremely
investor
low.
may not be privy to this information.
Investor is not privy to this information, but when we look at the data, we can draw some comfort
Sure.
from it. Nothing can prevent it from happening, but it's unlikely. The other philosophical point here is that unlike in debt, in equity you get marked down if there is a stress event, a black swan event, you get marked down immediately, whatever that number may be, 10, 20%. So therefore, the incentive for someone to redeem goes down dramatically in a week's time or in 2-3 days time. Unlike in some other asset categories where it is not so transparently mark to market. So that I think is the big is the big difference between equity and other asset categories. But I was coming to the other point which mentions about the other parameters. So you look at our portfolio, for example, our number of days to liquidate 25% of the portfolio is 17, which is not very high, not very low, of course, but for our size, I think it is reasonable. The reason being that why it is reasonable especially is because our proportion of small cap in our small cap fund is 95%, close to 95%. So it's a pure small cap portfolio. If I look at if you compare it with the industry, this is the highest small cap proportion in any small cap fund. So we are obviously having a higher proportion. Our positioning has been that we will run it as a pure small cap portfolio. So that's number one. Number two, despite that, how do you manage the risk of liquidity is by having a lower beta portfolio, by having a lower standard deviation, and also by having a valuation which is slightly more reasonable. So let me just give you quickly the data points on that. Our portfolio beta is 0.67, which is one of the lowest, which means that if the small cap index were to go through a big correction or big round of volatility, we will be less volatile, much less volatile than the index itself. Our standard deviation, which is a fallout of beta partly, is also very low compared to the benchmark standard deviation, which again tells you the volatility in our portfolio. And the third thing is our valuation. Our portfolio valuation P ratio is trailing P ratio is about 21.7, which is at a 25-30% discount to the benchmark Nifty Small Cap 250's P ratio of 28 something. So in short, we are running a more valuation conscious portfolio. We are running a less volatile portfolio, and that is how you take care of balancing the liquidity risk which is there in small cap. Some of our peers who are also bigger might maintain a higher proportion of large cap, mid cap. But for us, the way we have decided to do is we'll keep the small cap proportion as high as possible, but balance it through the other parameters which I mentioned.
Understood. I think this has been very insightful, Rahul. Thanks for sharing your views on this. I think now it looks less stressful for sure. On that note, that's all we have for today. See you again next time. Thank you.
Thank you, Anand. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.